as we move on. So we would move on with the history of amendments, moving on to the rates of income tax, and then categorizing the amendments under various headings as mentioned here, right from widening of tax base, measures to check evasion, incentives, distressed enterprises, improving tax administration, anti-abuse, and ease of engaging with taxpayers, rationalizing certain provisions of income tax to make it a lot more practical, and more importantly, certain amendments made to other statutes to the extent they're relevant for direct taxes. Yes, so when we look at the history of amendments, friends, if you notice over the last 10 years, it's more or less moved anywhere from 33 to higher of 112. So our average run rate is anywhere between 60 to 65 amendments. And this budget has also lived up to its reputation. So we have about 68 amendments under the present regulation. Some of it clarificatory, some of it rationalization, and many of it in terms of expanding the measures to expand the widening of tax base. So to have a quick peek, rates of tax. So this is something which I guess was specifically mentioned by our Honorable Finance Minister. So there is no change per se as far as the slab rates are concerned. So they've remained more or less similar to what they were. However, for companies whose turnover now up to companies with a turnover of up to 400 crores, right? The concessional corporate tax of 25% has now been extended. So earlier, friends, it was up to 250 crores. That's now moved to 400 crores. And if you notice, as was mentioned in the budget speech, 99.3% of the companies now pay only a 25% tax rate. It is not applicable for LLP. So as of now, it's not applicable for LLP. And the challenge here is the surcharge. Again, we're focusing more on the surcharge applicable for individuals who are earning a significant amount of income. So if you notice, friends, this is where the real piece comes into picture. So resident and non-resident individuals, HUFs, AOP, BOI, if the income is between 50 lakhs and 1 crore, it's 10%, 1 to 2, it is 15%, 2 to 5 is 25%, and exceeding 5 crores is 35%. So I'm sorry, your webcam is blocking the table. I don't understand, Sai Charan. I think I'm able to see what's on the other end as well. So the surcharge rates have been significantly enhanced from the present rate of 7 or 12% to 10, 15, 25, 37. So people who are going to be at the higher end of the spectrum would now have a significant outflow of taxes. And that's a concern with many SSCs now, especially if you look at the high net worth people putting their money in passive incomes like fixed deposits and stuff. Already the rate of return is only going to be about 7%. On top of it, if there's going to be a 40-45% effective tax rate, the effective yield on investments is going to be far lower than the inflation itself. But of course, the government also had their own reasons. One interesting thing which we are yet to wait and see is the government said they would be providing incentives for large value taxpayers. So we will have to wait and watch as to what are the kind of incentives which are being promoted for these schemes. Otherwise, there is a significant deterrent with surcharge of 37% for taxpayers, for high value taxpayers. Yes. Next, moving on, friends, in terms of getting your measures for widening and deepening of tax base. So let's quickly understand what the government stands for. So if you look at it, friends, currently we have 194C and 194J, where the payments made for contractual payments and for professional payments, the persons who are not covered under tax audit in the earlier year are not required to deduct TDS. So there's a 2% tax rate under both sections. What the government has said is they've inserted a new provision for 194M, where even if the person making this payment being an individual or a HUF is not covered by tax audit, however, makes a payment in excess of 50 lakhs in aggregate towards a contractor or towards professional charges, then TDS at the rate of 5% has to be deducted. The age-old wisdom was, since these people are small-time assessees, it becomes an onerous activity for them to obtain a TAN, file TDS returns. So the government has said you don't need to obtain a TAN. You will go ahead with a PAN number, and more importantly, very similar to what people do for real estate properties, a similar mechanism for tax payment is envisaged in this case, and the tax TDS rate is now made at 5%. So individuals and HUFs not covered in the tax audits. So even salaried individuals, right, who are making payment for, say, construction of a house, if it exceeds 50 lakhs in a year, then obviously there would be a TDS now under this proposed provision. And next, this is again a pseudo tax planning which some of the developers have been cleverly using. So if you look at it, friends, we've had 194 IA where if you're purchasing a property, on the consideration value there is a 1% TDS. So, however, what's happened is consequent to certain I wouldn't use the word manipulation, certain planning, where the developers have said, for the, let's say you're buying a flat for 2 crores, the developers have said the cost of the property is 1.25, you pay a separate 25 lakhs for car park and 50 lakh for amenities, and the remaining 75 was not subject to TDS. So now the government is felt, irrespective of how or what you call that particular transaction as, it ought to be regarded as consideration for the property. The definition of the term consideration has now been defined, and there is a tax obligation of 1% on the entire value, inclusive of all possible amenities and clubhouse and car parks and everything of that sort. Next. So this is again another expansion clause. 56.210 was a provision to tax gifts which are received by a resident, gifts which are received by a person. Now we have section 9 which says, in the case of non-resident, which talks about income deemed to accrue or arise in India, if the sum is if the income is received outside India for a non-resident, such amount is not subject to income tax. However, the government of India has always felt if a resident is making a payment to a non-resident by way of a gift, it is still Indian income. So now they've expanded the scope of Section 9 very clearly. Now they've categorically expanded the scope of Section 9 by saying that gifts received shall also be regarded as, by a non-resident, shall also be regarded as taxable income. And the scope of Section 224, which defines the term, so gifts received by non-residents shall also be regarded as taxable. However, this cannot be a unilateral levy given the fact that India has more than 96 double tax avoidance agreements. So therefore, gifts taxation shall still be subjected to DTA. So there is a miscellaneous article in all DTAs which India has signed. The miscellaneous article shall stand good if it's more beneficial to Section 9. But as we speak now, gifts received by non-residents from a resident in India shall now be deemed taxable under the provisions of Income Tax Act. Next. This was something which existed in India some years back. If you notice, friends, earlier we had this 1/6 criteria, where people who did not have a taxable income were still expected to file return of income if certain criterion were met. For example, if you purchased a car or you bought a house or whatever could be the reason. And subsequently, that situation was done away with because the hardships to the SSC was excessive. However, the government has now reintroduced that under Section 139, where they say that if you have deposited more than 1 crore in current accounts with a bank or a cooperative bank during the previous year, or you've incurred an expenditure in excess of 2 lakhs, either for yourself or for any other person, or in the case of foreign travel, or you've incurred an expenditure which in aggregate for a year exceeds 1 lakh towards consumption of electricity. So you look at it, friends. So if your electricity bill is more than 8,500 rupees per month, you're supposed to file your tax returns. I think now we have come down to that level of, or any other category which could be notified. So the best part is any other such other condition as may be prescribed. So which leaves it open for the government to keep issuing notification or circular in this, to keep on adding categories of persons who would be expected to file tax returns. So what is a bit, I wouldn't what is a bit amusing here is if your electricity bill exceeds 8,500 rupees a month, you're supposed to file tax return. So that's amusing. And the list doesn't end here. The government now has a larger possibility of expanding the horizon of people who are required to file tax returns. So across, you would see, friends, there is a concerted effort to make people to gather data at this point in time. We will be seeing even in the 285BA annual return also where the government's push is now coming in towards expansion of data collection to facilitate two things. One, pre-filing of income tax returns, and second, to catch hold of evaders as much as possible. And this is the other provision where they've said if by virtue of the rollover provisions for exemption under section 54, you are not required to file a return of income, going forward, you would be required to file a return of income, even though your total income may not be in excess of the maximum amount chargeable to tax. So, and we are yet to wait and see what the total space, because of this particular section, is going to be. The government is proposing to expand the category of persons who are required to file. One reason, friends, in our opinion, why the government is expanding this category of list is there is a larger punishment for concealment of income vis-a-vis non-filing of tax returns. So if it is made mandatory to file a return and you file some number, and subsequently it is proven that that number is far lower than what you actually ought to have filed, then given by the recent circular which has come on 17th of June, the consequence could be significant for the violators. This is another amendment or another proposal which was publicly announced by the finance minister. So PAN and Aadhaar can now be interportably used. So if you don't have a PAN, it's still okay. You can use your Aadhaar to file your tax returns, and consequential provisions would now be applicable. So the intent seems to be to minimize the friction which a person has to undergo while filing a tax return. Especially we saw there are circumstances where even if you do not have income, you are expected to file your tax return. So in such situations, it makes more sense for the government to do away with the requirement to obtain a PAN. Next, widening the scope of financial transactions. So if you look at it, as I mentioned some time back, the government now wants to get into the mode of pre-filling your tax returns. So when they say pre-filling your tax returns, the data is likely to come from your TDS, your 26A's data is likely to come. If you have had transactions like purchase of mutual funds or sale of mutual funds or bank interest, so there is a possibility that this data could be extracted from your bank accounts submitted by the banker whom you have. So now with Aadhaar and PAN getting linked, and your Aadhaar being made as one of the key criterion, or not necessarily the only criterion, key criterion for identifying your tax data, it now becomes extremely easy for the government to port this data from multiple sources. So what they have done originally, where tax for 285BA annual return, the institutions were required to report to the government only when the value of the transactions in aggregate exceeded 50,000 in a particular year. Now, to ensure that pre-filling of returns is now accurately possible, they have removed this threshold of 50,000. So literally all the transactions will now get reported, and that would by default get ported into your tax returns. This is going to make our jobs far simpler, as well as for the SSC, and assessments are also going to be made far simpler as we move on. Now, promoting less cash or digital economy. So we've seen there are multiple sections in our income tax, right from 43(1) to 40A, 43CA, 44AD, 80JJA, where the emphasis is to encourage assessees, or rather force assessees to make payment by way of banking channels. So originally, the typical banking channel was account pay check, account pay DD, or NEFT. So now, to widen the vistas available, the government has now expanded the options available, and have stated any other option electronically for electronic transfer of funds is now available and would be deemed as payment made through electronic channels, and it would not be regarded as a violation for the purposes of all those sections which are mentioned under the Income Tax Act. Next, so this was also discussed on the floor. If you withdraw, let's look at it, friends. If you withdraw sums in excess of 1 crore towards from your bank account during a financial year, there would be a TDS of 2% on the transaction. So this would be deducted by your bank with whom you have this account. So it's be very clear. So where the withdrawals from a particular account exceeds 1 crore during a financial year, then the aggregate value of withdrawal shall be subjected to a 2% TDS. And again, friends, let's be clear on this. It is from a particular account it refers to. So this 1 crore limit, prima facie, going by the language of the proposed amendment, looks like withdrawal per person, per account, per annum. So you can have multiple accounts from where you can withdraw the total sums from different institutions or possibly from the same institution as well. But you would not have you would not be attracting 194N. And exemptions have been given where withdrawals are made for governmental payments or for payment to ATM operators, where obviously their business is to reload and refill cash at various machines. So as far as this provision goes, it's again a provision to promote a cashless economy. Next. Now, this was also mentioned by the finance minister, where if you notice, to move to a less cash account, new 269 SU is now being introduced, where every person carrying on a business shall provide facility to receive payment, or where his customers should have an option to make payment through electronic modes, provided the turnover of the business exceeds 50 crores. And further, they have stated that the RBI, in conjunction with the other banks, have been nudged to make this transaction costless. So literally, you are expected to make a provision for all your customers to settle your balances either through debit card, credit card, using your UPI app, apart from just giving a bank account. And it's now being made mandatory for all businesses whose turnover now exceeds 50 crores. So similar consequential amendments are now being made in the Payments and Settlements Act. Now let's move on to the incentives piece of it. So significant incentives have now been proposed for International Financial Services Center, where they have reduced the threshold for investment. They have done away with dividend distribution tax. I'm not getting into the detail at this point in time, given the relevance of these amendments for the audience at this particular point in time. Incentives on NBFCs at this. So for those of us who are doing audits or tax audits of NBFCs, see, currently what happens is banks have a mechanism where in the case of NPAs, they recognize the interest only on receipt basis, whereas NBFCs do not have that luxury. They are forced to recognize interest on accrual basis. Now, this has been a very constant demand by NBFCs, where they should also be provided a level playing field with banks. So this request has finally been heard, where the government has now set for two categories of NBFCs, two very highly regulated categories. One is deposit taking NBFCs. To give you a perspective, out of the 9,000 odd NBFCs in this country, only 220 NBFCs are deposit taking NBFCs, and systematically important NBFCs, which are where the assets under management exceeds 500 crores, which again is not more than 1,000 NBFCs in this country. But these two NBFCs now have the luxury of being considered at par with banks, meaning for their NPAs, they need not pay tax. I mean, they need not pay offer interest to tax on accrual basis. This interest will be taxable as and when the amount is received. Similarly, consequential benefits, means consequential amendments have happened in 43B, where any person who is making a payment of interest to these NBFCs, the interest shall now get covered under 43B, meaning this interest shall be available for as an expense claim only if it is paid on or before the due date for filing tax returns. So that is now being made. Next, see, offshore funds is one area where the government of India had significant interest, because there were many funds which did not have their fund managers in India, primarily because the fund manager would create a permanent establishment. So therefore, about 3 years back, the government inserted a new provision called 9A, where they said even if the fund manager is in India, he does not create a permanent establishment and the income will not be subject to tax, provided certain conditions are fulfilled. So what the government has done, the government has now expanded the relief, or they have now expanded or simplified the conditions which are available for this purpose. So what they've said, the corpus shall not be less than 100 crores at the end of the period of 6 months. This is a provision which was significantly watered down, and the remuneration shall be in accordance with the rules as may be prescribed. Next. So this was also mentioned by the finance minister, where if you purchase an electric vehicle, you would get an interest deduction of 1,50,000 under 80 EEB, provided the loan is sanctioned within the next 4 years from now on, and the SSE does not own any other electric vehicle as at the date of sanction of the loan. Now, look at it, friends. This is again very similar. You will see a very similar relief available for affordable housing. So, next, so this was an anomaly in the regulation, which is now getting corrected. See, offshore rupee denominated bonds typically refers to an Indian company borrowing from abroad in rupee terms. So under such circumstances, 194 LC provided a lower tax rate of 5%. However, Section 10 was amended to provide that the interest earned by these subscribers to these bonds would be exempt by virtue of Section 10. But a parallel amendment was not made under 194 LC. So there was a dichotomy where the income was exempt, but the payment was subject to TDS. That anomaly has now been rectified. So the exemption has now been provided, and any interest paid on offshore rupee denominated bond can be made without any withholding tax at this point in time. Similarly, we now have another incentive like electric vehicles, where under the new Section 80 EEA has been introduced by virtue of it. An additional 1,50,000 in excess of the 2 lakhs already available under 24 will now be available to the SSC, provided the value of the property does not exceed 45 lakhs. The SSC does not own more than one house at the time of sanction of the loan, and the relief is available for the next 12 months from where we are today. Next. And the definition of the term affordable housing for providing a relief to the developer is now being made in sync with the GST, because we also have this provision 80 IBA, where the developer also has a tax benefit for constructing affordable housing projects. That definition has now been made in sync with GST in terms of size of the property. So otherwise there isn't much. In terms of national pension scheme, the withdrawal limit has now been, the tax-free limit has now been extended from 40 to 60%, and the contribution limit has now been increased from 10 to 14% at this point in time. Next, startup incentives. So this irrespective of whether it makes tangible commercial impact or not, this definitely will make a lot of media and newsworthy headlines. So what has typically happened to incentivize startups? Couple of very burning issues which were there. One is the angel tax. Second is the carry forward of losses. So now before I get into this, let's try and understand Section 79. Section 79 talks about a case where, in the case of a closely held company, where let's say in the financial year 2017-18, there is a loss. And 2020-21, the company has a profit to set off this loss. Section 79 says at least 50% of the shareholders at the end of the financial year 17-18 should be shareholders of the company by the end of the financial year 2020-21. Now, if you notice in the case of a startup, the number of shareholders will just keep on adding, because as and when there are investors, there would be a dilution in terms of shareholding. And if the startup is supposed to do well, then the number of investors will only keep adding, and their original owner's shareholding would significantly come down. So to avoid that, Clause B was subsequently inserted, where they said it must be a case of not the percentage of shareholding. If the number of shares which someone held in the end of the year in which loss was made continues to hold the same number of shares in the end of the year in which the loss is being set off, then the provision for there won't be any case for disallowance. So which means even if new investors come, if the existing investors stay or existing shareholders continue to hold their shares, then you will not have any issue as we speak. Now, this is a fairly benevolent interpretation. But again, there are some practical challenges, because invariably when a venture investor comes, the first thing what he or she would do is to acquire the shares of angel investors, people who had put in the seed money or the angel funding. Their shares would be bought over. In such situation, there seems to be a case where this relief may not be available to the assessees. And further, where the government at this point in time has said this 50% of share capital or 25% of, in order to incentivize eligible investment in eligible startups, it's further proposed to extend the scheme available, the relief what we are contemplating, which was supposed to expire on 31st of March 2019. It's been expanded by 2 more years to 2021. Next, category 2. So typically what happens, friends, was section 56(2), which spoke about excessive premium received by companies would be taxed as income of the company. However, there was a relief which said that if this premium was received from category 1 AIF, the provision shall not be available. However, the section has now been made applicable to assessees, to companies which receive funds from category 2 AIF as well. So category 2 AIF has now also been made at par with category 1 AIF. Further, another case for incentives is we had the section 54 GB, where the government said if someone's going to start a new business and he or she sells a property, sets up a private limited company, uses the the proceeds of sale of shares from that house to put it into the private limited company as capital, uses that capital to acquire plant and machinery, then whatever is the value of the plant and machinery acquired shall be deemed as reinvestment, and there will not be any case for charging capital gains. This scheme was supposed to end by 31st of March 2019. That scheme is now extended to 31st of March 2021. Further, the case was the assessee should hold at least 50% of the equity capital in the company, which is now reduced from 50 to 25%. And the other condition was similar to section 54. For those of us who are familiar with section 54, 54 says you sell a house, you buy a house, you keep the new house for 3 years. Whatever is the reinvestment you have made will be eligible for capital gain exemption. Similar to that, 54 GB says you sell a property, you buy a machinery. But how will you buy a machinery? You will float a private limited company and you will invest whatever is the sale, your amount which you want to put for machinery into the company as capital, and use that capital for acquiring machinery. And it says you should hold that machinery for a minimum period of 5 years, and you should hold at least 50% of capital of the company. But given the practicality, the government has now reduced it from 50 to 25%. And they have said for computer and intangibles like computer software, the period of 5 years may not be practically feasible, so that they have reduced it from 5 years to 3 years. Honestly, so far, we have never come across a case for anyone using the relief, because invariably when someone sets up business, friends, I don't think the first step is to sell the house and put it inside the company. First, you try to pledge the house, borrow, and then invest into the business. If for some reason the business doesn't take off, in which case you would end up possibly selling the property, but the government has already thought of a distress case. Next, similar to 54 GB, this is another case of distressed transaction, but however, this is a real case of an assessee who's gone into insolvency. Imagine, friends, a company gets into insolvency through the NCLT process. Now, section 79, so any company which is obviously getting into NCLT would be a loss-making company. There are no two thoughts about it. Under such circumstances, what would happen to the losses of the company which is getting insolvent? Would the new shareholders be eligible to claim the benefit of this loss? So this was a fairly, in some cases, this could be a deal breaker also, because if we have noticed in the case of mergers and amalgamations, there are certain circumstances where deals actually happen for the tax value of the carry forward losses. So therefore, this loss was always disallowed by virtue of section 79. The classic case is SR and SR Steel and Arcelor, the current case which is going in favor of Arcelor. If SR Steel had some losses and Arcelor, being the new buyer, takes over the company, would Arcelor be eligible to set off the losses of SR Steel, assuming both are private limited companies? By virtue of Section 79, it says at least 50% of the shareholding of the company, of the shareholders of the company, should continue to remain as shareholders in the year of set off, which is not going to happen, right? It will take another 3-4 years for the company to make money. So therefore, the government has now come up with a proposal to say, if the company gets into a resolution process by virtue of NCLT, the provisions of Section 79 shall not apply to the SSC. In which case, the acquirer of the company under NCLT through the IBC process will now be eligible to set off and carry forward the losses incurred by the predecessor management, because here we are looking at it as an SSC. Next, so this is a practical benefit which has been provided to the. However, what is still missing is currently what happens where there is a haircut or a write-off of loans by the lenders and the company is being taken over. There is a case where such write-off is being deemed as income in the hands of the company, which is already going through insolvency proceedings. We are yet to receive clarity on that part of the IBC process. Next. Prescription of exemption from deeming of fair market value. So this is a relief which was given, which is more a practical relief. Today, friends, look at it. 56.210 and 50 CA both talk about fair value of the asset. Let's take the case of the asset being a share. 56.210 says if you receive shares as a gift, right, or for inadequate consideration, then you're supposed to pay tax as income from other sources. Similarly, 50 CA says where you're not able to determine the consideration of the asset, then the fair market value of the asset shall be deemed as the sale consideration. Now, under both these circumstances, look at what happens. First is income tax has its own rules for valuation. Let's assume it's an international transaction. FEMA RBI has its own set of rules. Companies Act has a set of rules for valuation. Now, which one will you adopt? And there is a very high possibility that you will have multiple mechanisms to value the same asset, and invariably the SSC could be in serious difficulty. So now the government has come back with a clarification saying for the purpose of these two sections, the fair value provisions and the income tax will not apply. The board will come up with the rules where they say, possibly they would say that the valuation mechanism adopted in the other regulations will be applicable for income tax as well. This is again a welcome step in this direction. Next. So 195.2, where you are dealing with a non-resident and you are expected to either apply for a nil tax or a lower TDS rate, which is currently manual. The government is now proposing to make that electronic, which is again a welcome step. Again, a statement of transactions on which TDS has not been deducted. Currently, it is. I wouldn't use the word manual. You're supposed to give it in a CD or pen drive to the government. Now they're going to make it as part of your ETDS. Anti-abuse provisions. 115 QA talks about buyback tax. So I'll just give you a quick history of buyback tax. So this goes back to the era where we had the India-Mauritius Treaty, India-Singapore Treaty, where investments used to come from Mauritius or Singapore to India. And let's assume a Mauritius company has a wholly owned subsidiary in India, and this wholly owned subsidiary in India has made significant profits. Now, one way to take back this profit is declaring dividends. But declaring dividends, the company has to pay 30% tax. So what the companies were doing is they were doing a buyback transaction. In which case, then erstwhile Section 46, there was no element of you were eligible for indexation. The companies would take back their funds without any tax incidents in India. The government felt they were being shortchanged. And even by virtue of buyback, earlier we had, even now we have, the capital gains tax will be taxed in Mauritius and Singapore, where both these countries do not have capital gains tax. Subsequently, the treaties are under the capital gains tax is 7.5%. But the government felt it is still not adequate and we are losing money. Instead of taking it as dividend, these companies were doing a buyback. So they introduced a case of 115 QA, where they said if you do a buyback, you'll have to pay 20% distribution tax. Now, they parallelly inserted 1034A, where they said if you have paid distribution tax, a buyback consideration is not taxable in the hands of the recipient. Fair enough. But this was only restricted to unlisted companies because they were the ones who were doing this. The government felt listed companies were now abusing this loophole available to them. So going forward, let us remove this relief available for listed companies. We will include listed companies also under 115 QA. So for listed companies, buyback will attract 20% distribution tax, and there won't be any tax in the hands of the recipient. Next, 12A talks about registration of trust and cancellation of trust registration under certain circumstances. Now, today, if you notice, companies under Section 8 trusts under Section 8 of the Companies Act will also be regarded as, can also be a charitable institution. And if there are instances of non-compliance under the Companies Act, that can also going forward lead to a case for cancellation of registration. So what they have now proposed to amend Section 12A is the trust, at the time of granting the registration, the commissioner needs to satisfy himself that all the other governing regulations, for example, Section 8 of the Companies Act, have been complied with, and there must be an ongoing compliance. If either of these two are not there, that becomes a case for cancellation of registration. Next. So this is something where the government seems to be hell-bent on doing some serious measures. One, this at the corporate level, they have now agreed for Ind AS mechanism in the event of demerger, because just a quick back. So according to Ind AS, you are supposed to use a fair value method of accounting, especially in the case of demerger, and that's what is mentioned as per Companies Act. Income Tax Act, we recognize book value now, and there are practical challenges in accepting Ind AS as well as your income tax historical cost basis. Representations have been made. The government has now come back saying you can go ahead with your Ind AS system for the purposes of demerger. However, from what we understand, as far as tax liability calculation is concerned, it would still go ahead based on historical basis, because the base number to the fair valuation, whether it is upwards or downwards, there won't be a tax consequence as far as income tax is concerned. Next, this is again a fantastic relief. If you look at it, friends, we have 40A1A, where if a domestic transaction is there, TDS has to be deducted, and you have not deducted TDS. And the recipient, on the other hand, has shown whatever you have paid as income and filed his tax returns. So as per the existing provisions, the date of his filing tax return shall be deemed as the date of your deducting TDS, and you shall be allowed deduction. Now, imagine a similar transaction happens where you have made payment to a non-resident, but the non-resident has filed his tax returns in India, paid whatever taxes it is there. Why should you still be penalized for 201? And why should the disallowance under 40A1A still be, or under 40 still be applicable? So therefore, the government has said, in order to extend the relief which was made available to the domestic taxpayers, even to international payers, we shall go ahead with a similar provisions for payments made to non-residents, provided such non-residents, if they have filed their tax, paid their taxes and filed their tax returns, the date of filing shall be deemed as the date of payment, and interest will stop from that date onwards, and disallowance will also not be forever. Next. Now, this is a provision for advance pricing agreements, friends. So this is more clarificatory in nature. So advance pricing agreements technically refer to a case where if you're doing an international transaction and there is a transfer pricing implication, you have an option to go to the revenue and say that this is a transaction I intend to enter into, or I've already entered into with my associate and enterprise, and you can go ahead submitting your agreement to the department and take their concurrence in terms of margins and costs for this transaction. If the government gives a blessing, the revenue CBDT gives a blessing for this, it is valid for a period of 5 years. Either it can be prospective or retrospective. Now, where it happens retrospectively, and assuming for the earlier years your assessment is already complete. Now, going by the APA, you will now do a modified return. So there were confusions whether for this modified return, should the assessing officer do a reassessment or should he just recompute and give? Now, clarification has come that he should just accept your modified return in the light of the APA, which has been agreed by the CBDT. He need not do anything else. So this is more clarificatory in nature given the nature of the transaction. Next, this is fairly interesting as far as secondary adjustments under transfer pricing is concerned. Just give a sec, friends. Yes. Now, what happens is we've got this case of primary and secondary adjustment. I'll give you an example. Let us say you are exporting to your associate enterprises in Germany. the transaction value is 5 crores. Now the department says, no, it should not be 5 crores, it should be 6.5 crores. Now you, on your part, says, okay, I'll pay this 1.5 crores of addition and be done with it. Let's buy peace. But what this 1.5 crores also leads to is, it's an acceptance by your end that you should have billed 6.5, but you have only billed 5 crores. So for this 1.5 crores of primary adjustment, the government now deems this 1.5 crores as loan given by the Indian company to the foreign parent. So therefore, you are now deemed to bring that money into India. So here they have now given you one option here. First, you need to pay interest on this amount if it is not received in India. Second, if the foreign parent does not, or you want to put a full stop to this, pay 18% tax on additional income tax on this money. So literally, apart from paying your 30% tax, you will pay an additional 18% tax on this money for not bringing that money into India. So your interest will stop, but you will still have to pay surcharge based on your status, and then the deal is done. So this is a very, very significant tax consequence, especially whenever transfer pricing adjustment happens, friends, especially adjustments in excess of 1 crore, all these consequences will automatically follow. This could have serious ramifications as far as IFSC is engaged in international transactions are concerned. Next. Concessional rates. So this was again mentioned on the floor of the parliament, where the government felt the central public sector enterprise finance, they're going to bring in for the purpose of facilitating faster disinvestment. They're going to create a fund for this purpose, and the fund would be investing in central public sector enterprises. Similar, the fund will also get the benefit of concessional tax rate of 10 and 15% under 112A and 111. Next. So alternate AIFs or where vehicles where, let's say, a group of investors will come together, go through a fund and make investments. So the fund will have business income for what it does. Let's say fund management fees, it's business income. But the fund will make investments in, let's say, house property. It will invest in shares, it will invest in debentures, it will invest in deposits, from where it will have passive income. The relief under 115 UB was all these category 1 and 2 AIFs had a tax pass-through. Not forget category 1 or 2. AIFs had a tax pass-through, meaning on all the passive incomes, the fund will not pay tax, the investor will pay tax. So let's say 4 investors have invested in the fund. The fund has in turn invested in debentures. So the fund has earned interest income. This interest income will not be taxed in the hands of the fund. It will go back to the investor in the proportion of their ownership or investment. Now imagine a case where the fund has incurred a loss. What will happen? So there was no provision. So going forward, if the investor has held the investment in the fund for a period of 12 months or more, the investor will now get the benefit of loss as well. So that's a good relief which they've inserted. This amendment is more clarificatory in nature. Section 89 provides for relief in the event of arrears of tax, and where you received tax arrears for last 4 or 5 years at one shot, you will get a relief under 89. Even though this has been adopted across self-assessment tax 140A, 234 ABC interest, relief under 89 was not explicitly provided. Now it is explicitly being provided by virtue of this amendment. This is more clarificatory in nature at this point in time. Next. Earlier, 194DA for life insurance, any amount received from a life insurance company was taxed at 1% on the gross amount. But however, we also know under Section 10, a significant chunk of the amounts received from life insurance companies are eligible for exemption. So it created undue hardship for assessees, because you would have contributed over a period of say 10 years, you would have contributed 10 lakhs and you would now be receiving say 20 lakhs. Out of the 20 lakhs, let's say 10 or 12 lakhs is exempt. You need to pay tax only on 8 lakhs. Why should TDS be deducted on the entire 20 lakh? So now the government is saying we will deduct TDS only on the portion which is taxable, and the TDS rate will now be 5% instead of 1%. Next. 286 talks about country by country reporting. So this is typically for large value transactions in excess of 7,000 crores, where you're supposed to mention all the group company transactions to the income tax department. So I would, at this point in time, not dwell too deeper into it. Just at a higher level, Imagine a multinational group having operations in 50 or 20 countries, and it is supposed to report under CBCR in India. What will be the financial year for the purpose? The financial year for this purpose, will it be your income date as per Income Tax Act previous year, or will it be date applicable for the respective countries? So the clarification has come. It shall be the date as per the parent company's country of jurisdiction. Next. Some of the rationalization provisions where they have tried to make it a lot more clearer on certain transactions. Again, 92D, this again talks about country by country reporting. The government says, irrespective of whether a particular entity has international transactions or not, the data of that entity should be reported to the Income Tax Department in India. Again, friends, this will apply only when the transactions are about $1 billion, so close to about 6,800 crores or more. Is when this transaction will apply. Next, the government has issued notice for exemption of certain categories of startups from the ambit of 5627B. So therefore, where we are talking about excessive premiums, so that has now been officially mentioned within the Act. So this is more a clarificatory amendment in nature, nothing serious as such at this point in time. So quickly moving on. Now, this again, 17th of June, we had a circular where the government was mentioning what would happen if prosecution notice is being issued for certain offences. Now, again, in order to provide the manner of computing penalty, where the person has underreported or furnished income, return of income for the first time under 148, 145, 148 talks about income escaping assessment. That has also now been brought under the ambit of 270 capital A. This is again more clarificatory in nature, but there is a clear direction in which the government's policy making machinery is thinking. They want to strengthen the penal provisions where the fear of non-compliance is now fear and the consequence of non-compliance is going to be extremely expensive for the SSCs at this point in time. Next, this again is a more rationalization provision where the government has said the punishment, the failure to furnish return of income shall not attract penalty if the tax payable does not exceed 10,000. When we say tax payable, it is tax payable after giving effect to all your prepaid taxes. So prepaid taxes typically refer to TDS, TCS, and all these provisions. And they've increased the limit from 3,000 to 10,000. This is the inverse of Nirav Modi's case, where they've said if by virtue of DTA or TIEA, which Indian Income Tax Department has subscribed to, the government of India is supposed to obtain a property which is owned by a tax evader abroad. The government will facilitate whatever it takes to do that. Further, if the details of property of an SSC in default are not available in India, but if the SSC is a resident in a foreign country, the government would still go ahead and share such info with the revenue authority. So this is more an inverse TAA which the government of India is used to. Rationalization provisions, you no longer need to do any further separate form for filing refund. Your income tax return filed under 139 is more than adequate for refund, so there's no specific form available. Rule 68B talks about attaching and disposing of properties which have been attached towards settlement of tax dues. So earlier what they said, the time limit was 3 years for sale of attached properties. And the government as well, because of this time limit, they were losing money. They have now increased this time limit from 3 years to 7 years by an additional 4 years. Next. This is a very interesting amendment, friends, which we need to look at, the Black Money and Undisclosed Foreign Income and Assets Act. What typically happens when someone who has been a tax evader in India and subsequently becomes a non-resident? Will he be regarded as an SSC for the purpose of Black Money Act? If you look at the language now, post-amendment, SSC shall mean a person being a person resident in India or a person being a non-resident or not ordinarily within the meaning of 6(6) of the Income Tax Act, who was a resident in the previous year to which this particular income relates, or the previous year in which the undisclosed asset located outside India was acquired. So if you are a resident, you have committed a tax fraud, and subsequently you leave India and become non-resident, and you have assets abroad, it doesn't mean that you would be eligible for, you would be regarded as someone whose jurisdiction is outside India. Government of India still has the right and the ammunition to bring back the SSC to books by virtue of the amendment to Undisclosed Foreign Income Act. So this is this amendment has fairly wide-ranging implications. This again, income declaration scheme. If excess interest, tax, and penalty has been paid under the scheme, earlier there was no provision to obtain a refund. Now you can still get a refund under this section. Securities transaction tax in the case of options has now been rationalized. It shall only be the difference between the strike price and the settlement price, and not on the settlement price gross. Okay, so there have been some administrative changes to the Benami Provisions Act, friends, but beyond that, there is nothing significant at this point in time. So if you have any questions now, we'll be more than glad to take them up on this. In the meanwhile, would be grateful if you can share your experience of this webinar and suggest how we can improve on this. Be really good. They're also proposing to do a series of webinars on the National Economic Survey, as well as on the revenue and receipts and payments account of the Government of India, more to get a macro perspective on what actually means, because typically being chartered accountants, our understanding of the budget is invariably restricted to what should I say, the finance act, and more to do with the direct tax provisions or the indirect tax provisions. But there is a lot to the budget than just these tax proposals. So we shall be doing it. We should, obviously, all of you will be kept posted. We shall be doing it beginning from either this weekend or early next week. I would also urge all of you attend, just go through the fine print of the regulation of the finance bill. I think that would certainly give you a lot more perspective, and more so on some of the hidden clauses on black money law, and the TDS provisions are getting stricter by the day. So that's one thing which resonates more with what the National Economic Survey has mentioned, where they want to focus more on automated collections, and the government, and even the finance minister's speech also, where they said it's going to be a frictionless engagement with the taxpayer and having pre-filled tax returns. So what this also does, it minimizes our work significantly at this point in time. So, it's been an interesting budget overall at this point in time. I'll see. As far as the EV part of it is concerned, the Ministry of Road Transport will be coming up with a document on the policy at this point in time specifically. So this is outside the ambit of Finance Ministry at this point in time, I guess. But certainly there is a very detailed policy which is expected, because they did have consultations with many of the regulators, I mean the stakeholders, from what we are given to understand. But yes, it is not mentioned in this budget because her speech was fairly crisp and not too much into detail, more macroeconomics book. But they have given tremendous focus, so there is a motivation for people to buy. See, the GST is going to come down from 12 to 5%. There is a tax relief of 1.5 lakhs available to the SSC. So statement of financial transactions, that's like 285 BA if I'm not wrong. So that's where earlier we had a threshold of 50,000 for all the financial transactions to be reported, be it your mutual funds or anything of that sort. But now what they've done is they've removed the threshold, and because the government, as she said, she wants to have a pre-filled tax return, right? So for which all the transactions have to be reported to the government. Like it's going to be like a CIBIL report, right? So whatever you do. So hence, you don't need to worry about computation of tax return. It's already going to be pre-filled and computed. That's what was mentioned. Yes, there are. So that's a different issue. So we can talk on that, where the margins of all these OEMs in India are significant compared to the European counterparts. A typical car manufacturer in Europe has a margin of 4 to 4.5%. In India, the margins are upwards of 20-25%. So the issue is not about government reducing the tax rate. These guys have to be compared. I mean, they need to be willing to forego their profits. I think that is where. Yes, Rajendra. See, the challenge was we had about 70 amendments, and I don't want to drag it beyond 1 hour. But yes, see, you will obviously be having. We'll be sending the videos of all these, so you can certainly listen to it at leisure at your convenience. Of course. So that's where the so what we will do now is we will in the next week over a series of events we will be focusing on the macroeconomic changes which are being proposed in the budget, and that will give us a far better understanding because currently just 2 hours so we just took spent the entire time only to understand the tax amendments and tax proposals. So there, once we get to the macro and microeconomic part, I think we should be able to answer your question much better. Definitely, sometime next week you should have this in place. So thank you, friends, and I should actually thank my team at office for having compiled the 67 slide presentation in a span of what 1.5 hours. So uh, thanks a lot. And yes, surely our budget proposal would be out. Or for those of us, for those of you known as, so every year we come out of the budget publication. So this year it should be out. The electronic version should be out very soon, and the physical version probably by end of next week or early week after next. Thank you. Thanks a lot for your participation, and yes, looking forward to seeing you all next week. Thank you.